Welcome back to FT Markets. We're here today with Muthukrishnan Ramaswami, known in the markets as Ramu, to talk a little bit about what's going on with the Singapore Exchange. Thanks for being here.
Thank you, and good afternoon.
Good afternoon. So SGX has benefited tremendously from derivatives hedging risk in China shares. What's going on with that now with the big sell-off?
The SGX has always provided a hedging market for pretty much all of Asia. So we have, as you know, we trade the Nikkei, we trade the Indian Nifty, we trade the China A50. So quite often we are in this position where interest moves from one country in the market to the other. So we went through a couple of years ago under the Abenomics, all the interest was on Japan. We saw big volumes in the Nikkei, then we saw the volumes drop down. Similarly with the Modi wave, we saw the Indian Nifty. Now we're going through that with the China contract. Now in our context, we always have really long-term exposure holders who use our contracts for hedging these, and the reason they hold it on SGX is for ease of movement across markets. So they hold about maybe 30% of their exposure on our marketplace.
Does that mean you need to diversify into any new areas to find growth?
Our search for growth is constant. As Singapore, we are small, we're landlocked, in a sense that we have not much place to grow in terms of our own securities market. So we really look for things which are borderless. Our derivatives has been where we've grown. And in that, we've grown by asset class. We first started with the equity futures. We originally started with interest rate futures back in 1984. And so the interest rate futures and then the equity futures, and now we are kind of going into FX futures.
So you've scrapped plans for clearing US dollar swaps. What happened there?
We haven't scrapped plans. We built a platform to trade or to clear OTC traded interest rate swaps. We offer clearing in US dollars, we offer clearing in Sing dollars, and then we also offer NDF clearing. So we were expecting, as 3 or 4 years ago, the entire world was expecting that the series of clearing mandates would roll out across the world. But that hasn't quite happened. We haven't seen mandated clearing for these instruments in anywhere other than in Europe and in the US. And therefore, we didn't really have a lot of pickup in US dollar clearing. Most of the volumes we do are Sing dollar clearing, where the local banks clear with us and their global counterparties as well clear with us. So we didn't see the value in pursuing to offer the US dollar with not enough business, but at the same time kind of end up paying fairly stiff fees for use of LIBOR and for all those costs that are integral part of the thing. So we don't offer the US dollar anymore.
It looks like you haven't had a single IPO this year. What about, what are you doing in terms of trying to get the local market going?
If you look at the amount of capitalization of Singapore companies versus the GDP there or versus the market there, it's the highest in the world. So pretty much everything that can be listed in Singapore is listed. So the only other things, the two assets that haven't been listed are maybe the airport and the port or something like that, right? So we are there for any small company that wants to raise capital. We play that role very effectively. The Catalyst board, which is what enables that, continues to function well. We've had, I think, 6 issues on Catalyst for this year. They have all continued to do well. So the local role of raising capital for small enterprises which need it, we are doing quite well.
You're also looking at something with bonds, is that right?
Yeah, we're going to offer an OTC trading platform for bonds. We are focusing on the corporate bonds in Asia, both high yield and investment grade. We do believe that we need an electronic platform focused on Asian bonds, because we think that the next several years, the bonds will play an increasing part in the development in the Asian financial markets. They are underdeveloped, and most have depended on bank financing for infrastructure as well as for just growth in the companies that are in Asia. And they will have to wean away from that and then start going into the bond market.
Okay, great. Thanks so much.